Yeah,
Look at his face.
yeah. Too up, too down.
Look at his face.
Yeah, yeah. I wanted the crown and to be celebrated. I rented a tux and I ordered a mink. Stood in the mirror like mama, I made it. Proceeded to brushing the teeth in the sink. Caught me a grill and I'm so melanated. I polished the chain, I ain't gold in the link. And I got me a baby who gave me some babies. I'm raising a lady and building a king. Too cold. You too busy running with another man lane, I guess. Yeah, too bold. I be running on the one way, never change my set like I don't ever use my signals, yeah. I be in the lane myself, yeah. I don't gotta change my mental, yeah. And I ain't gotta chase my wealth, and I accept my daddy got a kingdom, and everything I ever got is his. If I ever got a problem, I'ma seek him. I never doubt him. Been about his biz, oh man. Been there. I ain't gotta ride on the wave when the ocean is his. Close with the kid with a
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, y'all? It's your partner Dale and Cliff. Back in the saddle again for another edition of Real Estate Friday Live. We call it the Investor Edge. Cliff, what's going on with you, baby? How you doing, big time? You all right, brother?
Man, doing good, man. Just, enjoying this week right now.
Yeah, man. How was the week, man? Did we get the bag, brother? Did we get the bag?
Man, got the bag this week, man. It was a good week.
We did, man. That is what's up, man. It's been a very good week for your partner as well, man. A little challenging sometimes, man, but it is what it is, man. But it is what it is, brother. And if you guys do us a favor real fast, I'm trying to get us reconnected, man, on Rumble. Rumble just decided not to do what it needed to do. But hey, it is what it is, y'all. I guess we'll repost it on Rumble. It's not one. Oh, here we go. It's sending out now. Rumble, we're coming. We're coming. But guys, if you could, guys, do us a favor, man. Like, share, and subscribe, guys. And if you are on any type of other platform, guys, do us a favor, guys. Click on that little button there, guys, a little bell there. So when Cliff and I come live, come kick with your partners, man. Let's get it in, guys. Cliff, we have a really good show for him today, man. Yo, man. This is in your space, Cliff, baby. Crypto, baby. Hey, guys, BlackRock, man, has a severe warning for what's going on in the financial system, including real estate. Guys, we're going to talk about that. Number two, man, everybody is focused on this Iran war, but Trump did something also on Truth Social when it came to the banks. He has a war between him and the banks, and it's centered around crypto. Number three, guys, because of this war, there's been a rise of crypto financing in the realm of real estate. We're going to talk about that, guys. And then lastly, guys, what you should do as an investor to be able to take advantage of what's going on with this shift in the financial system, Cliff. So, Cliff, I knew that you would actually like this, man, because this is in your wheelhouse, guys. This guy, Cliff, he humble, y'all, but Cliff is a cryptocurrency guru. Cliff, am I right, Doc? Am I wrong? Talk to people, man. Am I right? Am I right or wrong?
Man, I'm a beast with that crypto, man.
Man, that dude Cliff loves crypto, man. But guys, let's dive into the first topic, man, real quickly, man. It is, hey, man, BlackRock's warning when it comes to what's going on in this space, guys. Here it is, guys. We're going to talk about this, Cliff, and I really want your commentary on this, man, so we can see what's going on. Here it is. Let's dive into it, guys. Here we go. Here we go, guys. Here we go.
The higher interest rates that we've been seeing are now causing Wall Street to crack. It's gotten so bad that BlackRock, the world's largest asset manager, just said that you can no longer pull your money out from their private credit fund. But the real reason why this is such a nightmare for the Fed isn't just because BlackRock is losing money. It's because we're seeing the perfect storm for stagflation. Number one, our job market is not doing good. February was the worst month for the job market that we have seen since the pandemic. Number two, before the United States attacked Iran, inflation was already going up in the United States. And now, after the crisis in the Middle East, Oil prices are going higher, which are making more concerns for inflation. And now number 3, the part that most people are overlooking, but you definitely want to pay attention to this, I'll explain why, is Wall Street is beginning to crack, starting with these private credit funds. So I'm going to break this all down, and then I'm going to show you how you can use these shifts in Wall Street to your advantage. That way you can use it as a potential investment opportunity. So make sure you stick with me until the end. And by the way, if you are an investor, this is why on March 18th, I'm hosting a live, free, and virtual investor workshop, because if you're thinking about your investments, you're thinking about your retirement, and you're feeling a little bit of unease because of all the craziness happening, I invite you to join me on March 18th, because I'm going to show you my firm's research as to number 1, where the economy is moving, and number 2, how these changes create new and unique investment opportunities, because things are changing very quickly. It's a free workshop. It's live. I'm doing it twice on March 18th, once in the morning at 10:30 a.m. Eastern Time, and then again in the evening at 8 p.m. Eastern
watch
Time.
this guy.
Now, if you do want to join, please register soon, because we have a limited number of people.
Great.
We're all,
great.
but you have to.
All right, brother. Oh, what happened? Oh, what happened here? Here we go, guys. What just overrun? Whoa! What just happened here? I got you guys.
Up to $250,000. So this entire process is
guys.
very regulated. Private credit is a little bit different.
Here we go. Something just happened. But here we
So
go.
if you're below. Now, to understand why the private credit market is collapsing, you have to understand how the basics of banking works. Because when you go and you want to borrow money from the bank, the way it works is the bank is going to review your credit score, they're going to review your income, they're going to review your payment history, and based off of that, they will see if you can qualify for this loan, and this loan is going to be regulated by the Federal Reserve Bank. The bank is going to be regulated by the FDIC. That way, when you go and deposit money at the bank, well, you're protected, because even if the bank collapsed, you're protected with FDIC insurance up to $250,000. So this entire process is very regulated. Private credit is a little bit different. This company wants to go out and raise $300 million. And they go to this bank, they go to Chase, they go to Bank of America, just like you did, but the bank says, no, you're too risky. Because of whatever the nature of your business is, we are not going to lend you this money. So the bank says no. This company, because it's $300 million, it's not enough to go to the stock market and try to raise money from the public markets, so they get denied over there. Instead, they go to a third party. This other company right here, something like Blackstone, something like Blue Owl, sometimes even something like BlackRock, and they go and they borrow money from these third party companies, and then these third party companies will then lend this money. It's called private credit to this company. Now, there's two things that I want you to understand. This company right here that's making the loan, it's not a bank. So it's not regulated the way that a bank is.
Correct.
So it doesn't have the same oversight. It doesn't have the same rules and requirements when it comes to issuing loans. And these loans are not reviewed the way that these banks' loans are. The second thing is that because this is a private credit company, well, it's going to charge you a higher rate of interest. So it's a much more expensive loan than if you went to the bank to borrow that money, because you are a more risky borrower. Now you might say, well, Jaspreet, if these companies are making these loans without the oversight, why would this company in the first place go to borrow this money and pay the higher rate of interest? Because they can't get the money anywhere else. And because they're desperate, this private credit company is going to charge you a higher rate of interest. Now, this is where things start to become problematic, because now you have these private credit companies right here that are issuing these high interest rate loans to these companies, and these private credit companies are saying, we need more money to keep making these loans because we're charging high rates of interest. We're charging 10%, 15% rates of interest. So how about you as an investor come and lend money to us? So private investors would come and lend money to these private credit companies, hoping that they're going to make 8% to 12% a year, maybe even more in interest, because now you are lending money here. This company is going to lend it to these companies. But there was a problem. The problem is that these companies weren't always vetting who they were lending the money to. For example, more than 40% of the companies who borrowed from private lenders had negative cash flows when they took the loan.
Correct.
Meaning almost half of these companies that were borrowing this private credit were borrowing money when they were already losing money every single month. And what's been happening over the last number of months is that more and more of these companies are saying, we don't have the money to pay back these loans, we're just going to declare default. And now these private credit companies are not getting paid back, So they're losing money, and now they cannot pay back their investors, and these investors are regular people. They're pension funds, they're retirement funds, they're other banks on Wall Street, and now it's starting to cause so much pain that these private credit funds are shutting down and they are limiting investors' ability to even get their money back.
Correct.
We've seen huge institutions like Blackstone and BlackRock stop you from pulling your money out. Now you might hear that and say, well, Jasperito, I've never even heard of private credit before.
Now get this clip. They're stopping people from pulling their money out because what's happened is you have Blackstone, BlackRock, they're losing money because these private companies were giving credit to these banks. I mean, to these companies, they can't pay it back. And most likely, the lenders to those companies, guess who? BlackRock, Blackstone, Blue Owl. So what's happening is BlackRock, Blackstone, and Blue Owl, they're losing money because they're lending money to these loan originating companies that were giving to these companies. They could have negative cash flow, and they didn't rebound well. So now they filed for default. And now what? Do you see that could be a problem?
Yeah, I mean, it's follow the money, man. Especially anybody who's lending money, you have to be very careful about who you're lending it to and the business you're lending it to, or else, man, you lose all of it. Correct. And that's a hard thing to overcome when you have those type of losses.
It is, guys. So again, I wanted you guys to see what's going on. That's a longer video, which is fine. You're welcome to go follow that young man. He's very wise what he's doing. But guys, what I'm trying to say is why is BlackRock saying that there is signaling a risk in the system? Because why? They're losing money because they are the private investors lending the loan originating company the money to lend out to these companies. That's why they're saying there's a risk to the system, because why? It's their system. That's why. Does that make sense, Doc, or no?
Yeah, makes perfect sense. Yep.
So it's real simple, guys. So again, listen to what they're not telling you. What they're not telling you. If they only give you one side of the story, guys, that's a problem. That makes sense, guys? Here's what it is, man. So Cliff, man, let's go over to the next topic. And I think, guys, Cliff is going to love this one, man, because I believe that this is down his wheelhouse. Did you hear, Cliff, that President Trump, I know people have been hearing this whole story about what was going on with Iran, right? Which is fine. But there's also a war between Trump and the banks. There's pressure and regulation reshapes the entire financial system and has to deal with cryptocurrency, guys. Crypto. Guys, low key, Cliff is a guy that loves him some crypto. For a long period of time, he had been telling me, Dale, buy crypto, but I never did. Now, yo, I'm about to buy some crypto. You're gonna see why in a second. So clip in, listen to the video real quickly from my guy Mark Moss, and then give your commentary on what you think is going on behind the scenes. All right, let's get it in real fast. Here we go, guys. Come on, y'all. Here we go. Boom. Here we go. Let's get into it.
The world is watching Iran right now. Something happened this week that most people completely missed. Trump publicly went to war with the banks. And I don't mean metaphorically, I mean he called them out by name. And the reason why this matters to you is simple. The outcome of this fight will determine which side of the biggest wealth transfer of our lifetime you end up on. So in this video, I'm gonna break down exactly what's happening, why the banks were terrified, and what you need to do about it. So let's go. All right, let's just get going in this. Like right now, everybody is locked in on the war over in Iran, and they should. It's important, right? I get that. War, maybe World War III, Israel, Iran, China, oil supply, geopolitical risk, all of that, right? There's, of course, plenty of politics to fight over with that. And of course, that stuff, it all matters, okay? But while all the eyes are pointed over there, something happened this week in Washington that's part of a much bigger developing story. Something I've been talking about since probably, the beginning of the year. I think it's actually more consequential for your financial life than anything that's happening in the Middle East right now. Now, what happened is Trump went to war, but this time with the banks. And I'm not talking about like a policy disagreement. I'm not talking about a strongly worded letter. He literally posted publicly about this on his True Social account, and he basically drew a red line, and he named the banks directly. And he said, what they're doing is unacceptable. And the banks, well, they fired back almost immediately. Now, most people are going to see this as, I don't know, some political noise, right? A fight in Washington over some crypto stablecoin bill, and think that's boring and probably skip past this video, but that's a mistake. I wouldn't be making this video for you if that's really all there was, because I know that you can read the news on your own, but I'm here to help you understand what it means. I want you to think in second or third or fourth order effects. I want you to understand the historical parallels of what this means, because what's actually underneath this fight, right? The reason that the banks are spending tens of millions of dollars to stop this legislation, it's way bigger. It goes way deeper than crypto. This is about who controls money. This is about your ability to transact. This is about the monopoly the banks have held since 1913 that's for the first time being genuinely threatened. And here's why that should matter to you and I personally. Every single time the money system has restructured, at least in American history, this will be now the third time that we've seen this. The people who understood what was happening, they got wealthy, and the people who didn't, well, they got left behind. All right, so let's talk about what's actually going on here. And it really starts with a warning that was written, 200 years ago. What am I talking about? I'm talking about Thomas Jefferson. He was the third president of the United States. He was one of the original founding fathers, and he warned us all the way back in 1802. He said, quote, "The banking institutions are more dangerous to our liberties than standing armies. If the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks will deprive the people of all property until their children wake up homeless on the continent their fathers conquered." End quote. All right, so look, obviously these guys were super smart, right? They could think in these second and third and fourth order effects, right? They understood the real dangers of having a banking system long before those dangers were even apparent or visible at the time. Now, Jefferson didn't say that banks were greedy.
So, Cliff, why are you saying this stuff real quickly? What do you think about that quote from Thomas Jefferson concerning banks and armies, things of that nature?
Because as long as you're in debt to somebody, then you always owe them and there's some control there.
Correct.
So the person who owns it all, and remember, especially the fact that with fractional reserve banking, I can control you with nothing.
Yeah.
Right?
You're right.
I mean, it's that, and so that type, hey, I'm going to put on my book that you have 100K in the account.
Yeah.
When actually there's only 10,000 in that account, and I've lent the rest of your money out to go earn more money so that my cash flow is strong and you can't pull your money out. And if you don't believe me, go ask for all of your money out of your own account. I've asked for a decent amount of money out of my account recently because I wanted to make an investment. All of a sudden you get questions.
Yes. You do. What you need the money for, and if it's a large amount, let's say 100K, 200K, come back in 3 days. The money's not there. They have to go in to other banks and collect the cash. So they don't have the cash on hand enough to even for you to even come and get your money out, because they were trying to protect themselves from what they call a run on the bank, right? So that's fractional reserve lending. Go ahead, Cliff.
No, I was going to say, we already saw this, 2 years ago?
Yeah.
Silicon Valley Bank.
Yeah.
There was a run on that bank. And it's most people don't understand that the banks are barely making it. They are just paying their bills month to month with the cash flow that comes in.
Correct.
So it don't take much. It takes 10% of their customers to say we out.
Problem.
And that business, that bank is insolvent.
That is correct, guys. So let's keep going. Just wait till it gets to crypto, Cliff. This is where it gets really interesting. Let's keep going, guys. This is a very interesting thing. Listen, guys, here we go.
Right? Which they are. He didn't say that they charge too many fees, which they do. He said they were more dangerous than armies. He said they would systematically strip citizens of their property. And he said it would happen so gradually that most people wouldn't even see it coming. Now, was he being dramatic? was he describing the precise mechanism of how this works? What's important to understand is that Jefferson, he wrote this before the Federal Reserve even existed, right? He wrote it before Nixon closed the gold window. He wrote it before there was any major restructuring of the American money system. But he knew it because he was watching the early formation of banking power, right? He was alarmed enough to write it down as a warning for future generations. Now, unfortunately for us today, that warning, it wasn't taken seriously. So here we are 200 years later, and the system that he was afraid of, the system he feared, it's the exact system that we have, all right? But now that you understand what Trump is actually fighting for, but of course, if you're not up to speed on the specifics, you need a little bit of context on what's been happening in Washington over the last year, right? Because this didn't just start this week, right? This has been going on at least since the beginning of the year. It's started really when Trump came back into office. Now, one of his stated priorities was making the U.S. the crypto capital of the world. Now, he actually started delivering on that, right? So earlier this year, we saw Congress pass what's called the Genius Act, and that was a really big deal. It was the first federal regulatory framework for stablecoins that was ever passed in the United States. It was the first time there were clear rules around what a stablecoin is, how they should work, and more importantly, who can issue one. Now, if you're wondering why stablecoins even matter, hang on, I'm going to get to that in a second, because that's really at the heart of this entire fight. Now, the Genius Act was just the first step, right? It was the first piece, but the next piece of legislation is what's called the Clarity Act, all right? And this is where it gets even bigger, because the Clarity Act passed already through the House. It's now sitting in the Senate Banking Committee, and if it's passed, it creates clear regulatory framework for the entire digital asset market, which I know it sounds boring, I get that, but buried inside this bill is one specific provision. It's Section 404.
Here we go.
Now, Section 404 is what the mainstream press are completely missing.
Yes.
Maybe they're completely ignoring, but it's the reason the banks are spending tens of millions of dollars to make sure this bill never sees the Senate vote. Now, President Trump wants these bills to go through, right? He wants the U.S. to lead in everything. He wants the U.S. to lead in technology and every area of technology, including banking. But the banks, they're quietly lobbying behind the scenes to kill this administrative bill, the Clarity Act. They don't want it. Trump certainly has his hands full right now with everything that's going on in the world, like right now, but he's still watching all this happen, and apparently he's had enough, right? So he went this week onto True Social, and he posted something that, well, most of what he does we've never seen from any sitting president, and certainly what he said here has never been said by any president, at least publicly. And he called out the banks directly.
Yes, he did.
He said the Genius Act is being threatened and undermined by the banks, and that's unacceptable. He said that Americans should be earning more money on their money. He said that the banks are hitting record profits while trying to undermine the crypto agenda. And he said the banks should not be holding the Clarity Act hostage. And he named them. He called them out, right, on his public platform as president of the United States. Now, a lot of people, they read that and they think, oh yeah, whatever. Trump's just doing whatever Trump's doing, right? Political posturing. But the context matters here. Trump came into office wanting to make America the crypto capital of the world. He sees AI, he sees crypto as the next frontier of American economic leadership. And so he doesn't want to let the old guard, right, the technology adverse banks, hold the American people hostage over it. Now, the most powerful person on earth has publicly picked a fight with the bank, right? He's chosen his side. Now, to understand why the banks are on the other side, why are they willing to go to war with the president over a stablecoin bill? Well, you need to understand exactly what it is that they're protecting.
So, Cliff, before you get to what they're protecting, Cliff, what are your thought process on President Trump calling the banks out by name when it comes to standing against the cryptocurrency agenda that he's pushing?
Well, because it's going to directly affect how banks operate. Because let's be honest, the way that the banks really make their money, we understand, right? Fees, credit cards, transactions, all that. But the truth of the matter is, could me and you do it?
Yeah.
You know, it'd be difficult for us because really it's the technology to actually run all those effectively, to give the loans, track them. That's a very expensive software. Usually only banks could afford it because it's millions of dollars to have an accounting software that can do all those things.
Correct.
Multiple branches, all that. Crypto now that gives a financial layer that operates much like the
Correct.
banks. That me and you could get spun up for $50K.
Yeah.
way cheaper. And now all of a sudden, me and you have a crypto bank. People can come in. We can say, hey, here's our investments you can get into, all kind of services and products. And now that brings it to the average person. The banks go, well, why would they put their money with us when they can go put it over here and get all these additional benefits? It's going to completely undermine the banks because their competitive edge is weakened.
Yes, that is correct. Now, Cliff, we're almost done, guys. Thank you for your patience. Let's get the answer to what they're trying to protect. Okay, I think this is wise for us to walk through, is because of the fact that we can now understand from a nuanced standpoint what is being said or not said on the media outlets. Here we go. Let's get into it.
Now, this is the part where Jefferson, like his warning, it starts to make sense. Right now, there's approximately $6.6 trillion sitting in customer deposits at U.S. banks.
Wow.
6.6 trillion. That's your savings. That's your checking account. That's your emergency fund, and it's all parked at the bank. And what do they pay you for the privilege of holding your money? They pay you about 0.1%, maybe if you're lucky, 10 basis points. Meanwhile, at a minimum, the banks are making $200 billion a year on that same money, risk-free.
Yep.
They take your deposits and then they lend it back out at 6 or 7 or 8% on mortgages, on car loans, on credit cards, and then they pocket the whole difference. And then you earn nothing. Now, Jefferson called it out, right? He said the banks are depreciating your wealth slowly, quietly, every single year. Now, your bank tells you that, your money's available anytime, right? It's liquid. It's on demand. Anytime you can come withdraw it. Come withdraw it tomorrow if you want. But the reality is different, right? The second you deposit that money, the bank loans it out. Not for a week, not for a month, sometimes 15 years, 20 years, sometimes 30 years, right? That's your neighbor's mortgage. That's a commercial real estate loan. That's a 7-year car loan. Your money has been deployed. It's not stored there at the bank. This is called fractional reserve banking. And it works as long as everyone doesn't ask for their money back at the same time. So here's the problem, right? The Clarity Act creates this problem for them where Americans suddenly have a legal, safe alternative that could pay them yield. That's the piece. Banks don't want to pay you anything, but if I can put my money into stable coins and earn a yield, say 3.6% instead of the 0.1%, well then what are we going to do? We're going to start moving our money into stable coins. And we're going to move all our money into stable coins. And when we move all of our money over there, well, the banks don't have it. They can't just give it back. There is no money to hand back, right? It's all sitting in 30-year mortgages. It's in a mortgage in your friend's place in Phoenix, Arizona. If deposits leave at scale, well, the banks can't do anything about it, right? They can't liquidate those loans overnight to cover the withdrawals. That's what's called a bank run. It's existential, right? They're either forced to compete, I guess, by paying us the real yield. They could just do that, but that destroys their profit margin. Or they watch their deposits walk out the door, right? But neither of those options work for them. That's why they're going to war. That's why they're going to war over this. Not because they're going to make less profit, but because the math on enough exits doesn't end with a smaller business. It ends their business. Now, Jefferson saw this.
So, Cliff, he's saying that, I agree with 100%, but he's saying that the stablecoin or cryptocurrency play gives the consumer more of a yield benefit because they're making 0.01% to 0.03% in the savings and they're doing nothing. While the bank is making an obscene amount of fees and profit on that money. Essentially, we're giving them a interest-free loan by giving our money into the bank, right? Versus with stablecoin, we can move all that money over to stablecoins, right? Cryptocurrency, let's say, for instance, it's paying you 4 or 5%. Which one's more attractive, 0.1% or 4 or 5% of a yield?
Exactly. And with the crypto too, you have more access to your money. You could wire all the money out to your account in one day.
Yes.
Easy. And you can even do this with the cryptocurrency that you can't do with real money. You can create your own wallet. Meaning, I don't even have a bank. I store it personally on my own cold wallet. That would be the equivalent of you not having a bank, you have cash. But now you can have a developer, or there's plenty of them, cold, on your own computer, that's where you store all your money. It's digital.
Yeah.
And it's USD.
Yes.
And so now you have your own bank that you created. Now you can operate how you want to. That's the other part that the banks don't want. Wait, hold on a second. You can store your money digitally yourself? Yeah, the softwares that can do that for you. You pay, instead of paying the bank anything, you might pay a service fee of $50 a month. And now you can do that however you want to. And there's gonna be a lot of people who store it themselves. They're like, I don't trust nobody. I want my own storage. And that's gonna be how many billions of dollars in revenue they lose because of that.
Correct. He's right, guys. He is right, guys. I think Trump's play when it comes to a war against the banks is a good play because it forces the banks to have to compete for your money. It positions the consumer to be in the driver's seat. It does. Because now the banks have to, they incentivize to create their own stablecoin to compete with other software services to where which one gives you the more incentive. If I do it on my own, yeah, I get this yield on an annual basis, but do I get access to these other products? No. Can I get access to these other products even by having my own wallet? Sure. But the consumer is put back into the driver's seat to be able to choose, should I move my money over to another place of storage on crypto, or should I leave it with the bank? You as a consumer get to choose. Vet the bank, because right now the bank gets an interest-only loan from us all. You agree or you disagree?
Agree. Yeah, the banks are going to have to. The problem is that they can make the changes. They got billions. They can go ahead and invest in the infrastructure to make changes to their model in order to have it still be profitable and do crypto. The question is how much more profitable is this new system? It's not.
Right. Mm-hmm.
That's the problem. Is that now there's more competition. A smaller company can rise up with more offerings. And their profitability shrinks. They can't charge all the fees that they were going to before, especially if they start changing the credit card model like they want to. Mm-hmm. That's going to devastate the banks. Ooh. But it's going to hurt people too, because it's not going to be able to say that there's not going to be a lot of credit. Ooh. If they do that.
They do, guys. Now, why would it be incentive for the bank to change their business model? I'm glad you actually asked. Let's go to the next topic, guys. All right. Next topic, guys, is this here is we have the next topic is the rise of crypto finance, right? Why blockchain is becoming a parallel financial system. Guys, there's actually loans being done right now in the investor realm, right? That allows for crypto to be utilized in the financing. And also you have the government already coming out and saying that they're allowing for retail buyers to add cryptocurrency into their balance sheet so that they become more bankable. All right. So let's go to CNBC real quickly, guys. They brought this on, guys. Here we go. Let's bring on CNBC and let's see what they have to say about this whole thing, guys. So we can then begin to see what's going on. Here is a company that's on Wall Street right now. They're going to talk about a loan they actually did with crypto. Here we go.
Crypto conversation. Price of Bitcoin this morning got very close to 100,000. Join us now, Andrew Hones, New Market Capital founder and CEO. And today, New Market is announcing Battery Finance. It's a Bitcoin-focused asset management platform that combines cryptocurrency and other assets. I won't say real assets because that sounds funny, doesn't it? It's like, something other than Bitcoin, like a real asset. I'm not
tangible. How about
tangible? Let's call it tangible. And the first, you've got to explain this to us. The first time you're combining Bitcoin to actually make maybe loans, which why don't you explain it? Because it takes some of the problem that you normally have with lending, which is inflation, I guess, and it could actually lessen the risk and volatility for fiduciaries running pension plans.
Yeah.
Hard to believe Bitcoin could be a solution to pension fund management.
That's what we're thinking. Well, good morning, Joe, Becky, Andrew. I'm so pleased to be here. And I'm really excited to announce today on Squawk Box this loan that we've just completed. We combined a seasoned multifamily asset in Philadelphia, about 50 meters away from the First Bank of the United States, the one that Alexander Hamilton started. We combine that asset with around 20 Bitcoin. And we provided a loan to refinance the existing mortgage on the property, to provide the asset sponsor some funding for capital improvements, and with the remainder to buy the 20 Bitcoin.
Okay, we got to go backwards.
Go ahead.
You got to go backwards. We're just going to slow the whole thing down so everybody understands what happened. Okay. So there's a property.
Yep.
Physical property.
That's right.
Right, it's a
Multifamily, 63 units.
It's a multifamily property.
Nice.
The sponsor, effectively the owner of that property,
Yep.
needs a loan.
That's right.
Okay, they come to you.
That's right.
Okay, you say, we'll provide you the loan in the form of
A loan.
a classic loan.
That's right.
Okay, so you're going to give them cash.
That's right. Term financing.
Term financing.
Term.
And how long's the loan? Just
10 years.
10-year loan.
Shorter
Okay.
term.
Right.
At above market rate or below, or what's
No,
the
market
just
rate
a
interest rate.
I'm just trying to slow the whole thing. Okay, now let's introduce the Bitcoin piece into it.
That's right.
So no, explain how the Bitcoin piece
And
then
why.
relates. So the loan has been provided.
The use of proceeds is to pay off the existing financing. So
The use of the proceeds
of the loan
of the loan.
is to retire the existing mortgage.
Right. So there's an old mortgage.
Gone.
They're going to pay the old mortgage
That's
off.
been paid off.
Okay.
Now they have a little bit extra money to make some improvements in the property.
Right.
Right. So they have a little bit extra cash. So the amount of money you've lent pays off the old loan.
That's right.
It's also you have a little bit of extra to fix
Improve
stuff
the
up.
property, fix
Okay.
stuff up.
Yep.
And then with the remainder, which is a little bit
So you
more.
have even a little extra, an
That's
extra
right.
turn.
And that, instead of cash out,
Uh-huh.
it's Bitcoin in. And we use it to purchase some Bitcoin and add it to the collateral package of the loan. So now our loan is supported by both the traditional asset, the 63-unit apartment building,
Right.
and the Bitcoin.
So the loan, it was maybe $2 million more, so that's how you get the
Exactly.
Bitcoin out?
Exactly right. So it's
On the assumption that the Bitcoin's going to rise faster, and that will become an asset that's...
over the life of the loan for sure. So we think on the downside, this provides us with much better protection compared to a traditional lender, because a traditional lender, if something goes wrong, they have to recover against that particular building, which is idiosyncratic risk. Something might happen with the maintenance or
But
what
that
have
also requires conviction on your end that Bitcoin is not a volatile asset
Over time.
you.
over time.
And that is either going to go up or at least stay where it is.
Well, that's by fusing the Bitcoin with credit and by fusing it with traditionally financeable assets, it gives us the luxury of expressing that medium-term view on Bitcoin. And that's what's key. It's volatile in the short run. You know, I mean, minute by minute today, who knows, it could cross 100,000. That would be
How
exciting.
long's the loan?
10 years.
10 years. So
And the minimum hold period for the Bitcoin is 4 years. So what we say to the borrower is we say, look, you can repay the loan at any time for any reason with no penalty, which is a really valuable feature compared to a traditional loan.
Yeah, that's like a home mortgage.
Like a home mortgage almost. That's very unusual for commercial financing. But what we do say is that to the extent that the loan is repaid at year 4 or earlier, the minimum will release the property. But the minimum length of time that the Bitcoin has to stay in escrow is 4 years.
Andrew, go on.
So, Cliff, man, real quickly, we have this guy on the screen. You heard the entirety of that dialogue and the structure of the financing. Give us your thoughts.
It's a very unique type of structure. I was trying to think through it. So basically what it sounds like, let's say he has a building and it's worth $1 million, but he only owes 500,000 on it.
Correct.
Something like that. So he goes to the bank. They say, cool, we'll refinance you at 80%. So 800,000. 500K takes out the old loan. And that extra 300,000, instead of just giving you cash to fix it up,
Yeah.
I'm going to put that 300,000 and buy crypto.
Mm-hmm.
And with that 300,000 in crypto, I'm going to loan against that 300,000 in crypto at 80%, 70%, whatever it is. Let's even say 50%. That creates $250,000, or in this case, $150,000 that I'm going to give you in terms of cash.
Correct.
But you still have the $300,000 in crypto. I just lended against it. So to the bank and to the person, it's interesting because you're actually borrowing more.
Correct. With the threshold of 4 years, the crypto being involved with the transaction. You can do anything for 4 years with the crypto.
Right. So I mean, I can understand that because part of me is thinking, man, just give me my cash, let me do what I want to with it versus trying to use it as collateral. But my other thought process too is, if you could do this with Bitcoin, then why can't you do it with any other asset? I don't want Bitcoin necessarily. I want Google stock. Why can't you do Google stock? Why can't you do any other type of asset that I think I have a better chance of an upside strong? I want the S&P. So now it's offsetting my cash flow. So I wonder why Bitcoin specifically, other than they think it has a high upside, and since it's a loan, they're gonna get that money back regardless. But if it has an upside, the question is who keeps the upside?
Well, who keeps the upside? That's gonna be the language in the agreement, because if things go south, you now forgo that cryptocurrency. And if you don't have any crypto, they'll give you, hypothetically, in your example of $1 million, let's say they'll say, we'll loan you instead of 80%, 78% or 75%, right? LTV. And then the extra 5%, we use that extra 5%, not to give to you, but to buy crypto and to put that crypto into the deal. So now what they've done is they have allowed for the assets to support them as well as the cryptocurrency, because they're saying you're adding value to the actual asset itself to increase the valuation of the property. But also, we believe so firmly in crypto, and I believe because the government is behind it, that's the reason why he's saying this. It's the only reason why it actually makes it safe for him, right? We want to not only give you an extra 5% to acquire more crypto if needed, you are welcome to put any other crypto that you may have already on your balance sheet into the deal as well also.
Interesting. Okay, so does that, I'm thinking maybe you're right, but we're thinking wrong. Maybe the LTV is higher because it's backed by a cash asset.
Correct.
So pretty much I'm gonna lend you 90%, but I'm only gonna give you cash. Let's say that it's worth $1 million. I'm gonna give you, the loan is 900,000, but really I'm only gonna give you the 500 to pay out the property, and another 200,000, which is actually a $700,000 loan, but the extra 200,000 is buying crypto.
Correct.
And so to the bank, cool, we're still liquid. We still have liquidity
because they can leverage
and
it.
we have a reason to buy crypto. It's a loan. It's not us buying it. It's a loan. And to the person who's getting it, cool. I get 500,000, take out my loan. I still get the 200,000 to fix up the property, and I get from the bank a higher leverage to go buy crypto that I wouldn't have cash otherwise.
Yes.
If that's the case, that's unique to say I can give you a higher LTV if you include crypto as an asset in the deal, because to the bank, that creates more cash for us to lend against. It gives you liquidity, and if it goes up, we all win.
Yes, and the bank can also because if they lend you more money to buy more crypto, that crypto is most likely in the bank's name or some form of fact. There's some ownership for the bank there, to where they can add it to that balance sheet. Now, what can the bank do? They can leverage that cryptocurrency to go out and get more liquidity themselves.
Because so I'm going to give you an extra 200,000 to buy crypto. That's your cash, but then I'm a lend against that money to give it to you actual cash. So now only a portion of that money for you is in the crypto. You're like, cool, it's less because I already got the cash.
Yeah.
You have to pay it back. But if that crypto goes way up, you could sell that crypto and it paid off the loan. If it goes against you, it was only 5% loss anyway. So now you're betting, as long as it's higher in 5 years, it's a possibility to take out the loan and make additional cash. And to the bank, that's another asset, that's additional cash on our balance sheet that we can say. That's interesting. But it only works if they go higher LTVs.
Yes, and it makes sense for them to go higher LTVs because of the fact that it's attached to two different assets: tangible asset and a digital asset. And the tangible asset it's been renovated, so it's going up in value. So that theoretically, the rise in value of the tangible asset, the real estate, could pay off both of them.
And there's got to be something else there, because for them, they're thinking, okay, cool, I gave you the additional 5-10% in LTV, so you could have, but that extra is in crypto. And to them, they're going, cool, you still owe me what it was on the day of the loan. Let's say 200,000. So you still owe me the 200,000 because it's still a loan.
Yeah.
But I got you more cash out the deal than you otherwise would. So I still am owed the 200,000 regardless. I just figured out a way to use that liquidity to give you more money. And I put it on an asset that could go up in value. Like I said, my question is, what if I want a different asset? What if I want Ethereum? What if I want Polkadot? What if I want...
It depends on the valuation of the crypto. Because again, I believe they're making decisions based on the stable coin. The stable coin, all cryptocurrencies, because 95% of all crypto transactions are done with the US dollar. So it depends on the valuation of said coin. Ethereum, XRP, Bitcoin, you name it. You name it. Just saying, Cliff. Interesting structure, guys. But again, I believe, guys, that this whole scenario, man, when it comes to cryptocurrency, it is changing the entire threshold. Now, guys, the one thing about it is we have a licensed appraiser on the screen, and he's offering himself to give you guys for wise counsel. Cliff, man, tell everybody, man, about Hunter Appraisal, and also include how beneficial is it to talk to an appraiser during the your vetting process when it comes to property.
Just go to hunterappraisal.com. We work with a lot of different investors. We look with a lot of different people who are just trying to get different information on the property. We work throughout the state of Texas. And we'll also do commercial properties as well. And really what we are is an asset in two different ways. The first one is obviously being able to provide you value of the land, the house, the property itself to be able to determine that. But two, it's actually guidance. A lot of times people want to do additions or they want to do renovations to their property, and they're thinking they're going to get an ROI, return on investment, for that renovation. And appraiser can definitely tell you, hey, in your particular area, what's happening in this neighborhood, hardwood flooring is not going to give you the ROI that just a traditional laminate might get you. Or, you're looking at a 10% return on investment versus what you were thinking might be 30. So again, it's just additional information that we can provide. But go to hunterappraisal.com. We'll be able to help you out step by step and at least give you some guidance and be able to walk you through the process.
Okay. Again, guys, it is not normal to have access to a licensed appraiser up front. That's not normal at all, guys. So again, hunterappraisal.com, go there. And guys, lastly, guys, we are giving away a free ebook, guys, right here. It is called Distressed Property Investing. And I'm also adding a section over this, I do believe this weekend, first case scenario next week, of how to use AI to put together your scope of work, make after repair images to be able to show to the appraiser, right? Also to choose the right standard property in your subdivision to point the appraiser to. Does that make some sense, guys? And put this together into a package. So when you get to someone like a Cliff, you give him all of the information. We're talking about the scope of work, the materials that you're using, also to come to the scope of work as well. Also, we're talking about also the as is valuation comparables and the attribute values, all using AI. That's called I call it an appraiser package, an appraiser review package, so that you want to make sure that when it comes to an appraiser, guys, you take all thinking or guessing out of the equation. Because if you leave it up to the imagination of the appraiser, you're in some trouble. Give him all the information he needs so he can take that information, vet it. He's going to vet it. He can either use it or not. But 9 out of 10, he'll use it. Now, Cliff, as a real life exercise, if you get a scope of work detailing the materials that you're going to be using, the quality of the details of the materials you're using, and the cost, right, for the details, for the materials and the labor, you get a standard property that we're using as the standard of renovation completion. You also get images of the attribute value post renovation exterior and interior. You also get comparables within a half mile to a mile radius of the subject property for as is and ARV standpoint. If you get a packet like that, Cliff, how do you interpret that?
It provides clarity, because now I don't have to guess on, hey, what's the products you're going to end up using? What's the flooring? Is it laminate? Is it wood? I don't know. Right? Are you using custom windows or are you using standard windows? I don't know. I'm having to make guesses on those things. So if you provide that detail, now it's more clear and obvious. Okay, you're doing custom windows. You're doing 8 millimeter laminate, or no, you're doing 12 millimeter. Okay, cool. Those type of details give me more clarity in order to help decide what the valuation and what things are going for in that area. So I can do a breakdown to say, hey, okay, these different components, what I'm looking for in your area, this is what the valuation is going to be.
Real simple, guys. You got it directly from an appraiser, guys. To get access to the distressed property ebook and the AI appraisal review package, line by line or step by step implementation of that whole thing, scan the QR code on the screen, DM the word real estate to us, guys, or click on the link in the show notes, guys. But guys, so that's all we have, man. Hey, Cliff, you watched the Maverick game today, bro, or what?
Yeah, I'm gonna try to catch it.
Yeah, they're playing the Cleveland Cavaliers. This is gonna be an AO, man. So,
Oh man, yeah, we're gonna talk about next year, because this year is done. We letting Coop get learn a little bit. That's what this year is about. Because right now we don't even have the infrastructure for next year. We don't have the guys. We at least 2 years away from being a team to make the playoffs.
That is correct, guys. But guys, man, thank you for your movie time. Hey, go spend time with your family, guys. See you guys next week. God bless you guys. All right, y'all. Holla at you guys. All right, man. Peace. My whole thing is, one thing I hear a lot of the times when it comes to anybody in real estate is, I don't have the money or the credit or the time or the intellectual property. And I said, okay, no problem. I have the money, have the credit, have the relationships. I'll teach you how to locate a good deal, right? Buy below wholesale.
I love that.
And once I teach you that, right, I'll bring me the deal. Yeah. I help you underwrite the deal, which is fine. I'll even fund the transaction for you as well. So there's no excuses on the table at all. That's why we call that the cash flow club, period. So what happens is, people always ask me all the time, Dale, can you train me? Well, I don't have the time to do that. But what if I set up a platform for it to where you get on-demand training? Anytime you want to, because the training you may need may be after you get off work, early in the morning, during the day. You just log into your account and get the same training as if I'm sitting there one-on-one. We're talking about our attorneys, our general contractors, our appraisers, as well as me, talking about how to structure your business, how to put together what they call a power team. A power team is very important. How to put a deal together, right, and buy it at the right price point. How to market. There's one technique that people don't understand, that you can actually get a list of properties that from your city for free.
Whoa. So walk me through that. Like, you can physically get buildings or homes or properties available for free?
Yeah, I'll send you guys the bill in the mail. It's real simple. What you can do is you can actually call down to your city and ask for the violations division. What happens is you say, hey, I want to see what homes in our city actually have violations. What are violations? High grass, no paint, vacant. You have boards on there. Those are actually violations that the city, or citation that the city has actually levied against that property. They'll give you that list for free. It may be a little bit of a fee, maybe $100.
Sure.
But it is what it is. Then what you do is you actually you can contact those sellers of those properties one-on-one.
Wow, and that's how you make your money. That's one way. That's one way.
If you'd like to learn how successful real estate investors make money when they acquire real estate, but not when they sell it, click on the link below, swipe up, DM me the word real estate to download our free ebook, Distressed Property Investing. The blueprint is in the ebook. Stay blessed. I'll let your partner and download the ebook today. What if you could help families lower their bills and get paid for it? Healthcare premiums, insurance rates, and loan interest just keep climbing higher. And most people just keep paying without knowing that there's a better way. We use a fintech platform that connects people to lower healthcare costs, competitive auto and home insurance, better loan products, higher yield bank deposits, and even ways to cut energy costs, all in one place. It's the same technology that banks and big corporations use currently. But now entrepreneurs like us can leverage this technology to build an income stream and help others save. Take our 30-second assessment to see if this business model is a fit for you. Click on the link, watch the short video after, and let's explore what's possible.
Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Bless God, give